I'm Dylan Ratigan. I've interviewed nearly every CEO and most world leaders during the past 25 years. And now on Bootstrapping, I'm turning my attention to the new CEOs and the irrepressible entrepreneurs leading the next generation of innovation in the world. Welcome back to tastylive. I am Dylan Ratigan. Time for another episode of Bootstrapping. Our guest today, Matt Sullivan, the company Quantum Re. They're raising money right now on a platform called Republic. You can check out their listing at republic.com/quantmre, M-R-E, quantmre. Matt, I was reading about the business. It sounds ambitious.
Thank you, Dylan.
Nice to meet you. In essence, it sounds like you're looking to use crypto or the blockchain or some derivation of the blockchain / crypto to allow homeowners to access liquidity in private residential equity in a way that they only have to pay it back upon the sale of the home. So there's no actual debt. Do I understand that correctly?
That's absolutely right. But what I want to do is really separate those two things, blockchain and crypto on one side, and the solution we provide to homeowners. So the blockchain element of what we do, and I'll come on to that in more detail in a moment, is really using the blockchain for its pure technology. So we don't actually have anything to do with crypto. We just use blockchain as part of our marketplace, and I'll explain what that is as well. But essentially, the problem that we solve for homeowners is to enable them to access their home equity without taking on more debt. So that means if you have equity in your home and you either cannot borrow money because maybe you don't qualify for a mortgage or a HELOC, or you don't want to borrow money, in other words, why would you want to lose that 2.5% rate that you locked in last year and exchange it for a 6% rate just to get some more cash? So at the moment where we have huge amounts of equity, more equity in people's homes than has ever been before, and we have high and increasing interest rates, what we do is we invest with homeowners, and that's why we're very different. So we provide homeowners with liquidity in exchange for a share in the future value of their home. So many of you will be familiar with this type of concept. It's very similar to an option agreement. So there's no loan, there's no monthly payments, there's no interest. It doesn't appear on the homeowner's credit report as more borrowings. It gives up to $500,000 worth of liquidity in one lump sum to the homeowner. They can use it for whatever they want. And for us, it creates a very compelling real estate asset because our investors are able to buy into the equity of owner-occupied homes at a significant discount to the current value.
Brings up a couple of significant questions. The most important one, I would say, well, they're probably equal important. One, who determines the value of, so if I'm good for $100,000 worth of your house or a dollar worth of your house, who determines what percentage of your house I just purchased or what percentage of your home equity I just purchased?
Well,
who determines the valuation on the houses at the time of the transaction, to say it simply, and then I'm assuming that there's a payment that is an obligation to the homeowner to repay that investment upon the closing of a sale of that house.
Yes, that's two very good points. Now, the first question you asked about valuation, it has to be independent, very similar to any mortgage or HELOC. It's an independent valuation. Now, we use either an appraiser or in most cases, we use an automated valuation, which is the same process that mortgage bankers and other types of lenders use to establish a very competent, accurate, independent third-party valuation. So that is something that is a very good question because that has to be independent from the beginning because we need to be able to establish what the correct price is.
And do you establish that, or does the homeowner, like if I'm the homeowner, is it my obligation as the homeowner to then provide a third-party valuation, or is
No,
that by your
we do all of
platform?
that. So you come to us as a homeowner saying, or you'll respond to one of our advertisements saying, yes, this sounds great. I've got lots of equity in my home. I don't want to borrow money, or I can't borrow money because I don't qualify. So tell me, how do I go forward? So we explain, first of all, let's look at the value of your property. Let's look at how much existing mortgage you have. If you have enough equity, typically you need to start with about 40% equity. So we're certainly not in the business of taking you right up.
You're not edging anything here. Yeah.
Exactly. So we leave you with a minimum 25 to 30% equity after a transaction. So after you've invested with you, there's still an enormous amount of equity that you have as the homeowner. So you've still got a lot of, so-called skin in
And
the
also
game.
that your investor has as a buffer to ensure that they can get paid back.
That's absolutely right. And that's very important, because what we're not doing, remember, is we're not increasing the leverage. We're taking a preferred equity position. And another important point is we don't go on title as owners. So we're not going to trigger any due on sale clauses or any tax revaluations. It's an option. And the option, second part of your question was, how long does it last? Well, it lasts for 10 years. So at the end of 10 years, you have to pay us back. And the way that you pay us back is calculated at the beginning of the contract, when we say, in exchange for this investment, you will give us, within the next 10 years, a fixed percentage of the value of your home, at whatever the value is at that time, but the percentage doesn't change. So typically, we would exchange 10% of the current value of your property in exchange for 20% of the future value. And that's great for the investor, because that allows the investor to buy equity in a single family owner occupied home almost at a 50% discount to the current market value. It's great for the homeowner because they get cash, which is tax deferred with no monthly payments and no added debt. And so it's
yes,
also
but they're selling the equity at a 50% discount, it sounds like.
It is, but over time, that actually, over a 10-year period, the true cost of that money is very similar to what the cost of a HELOC would be. So even though they're providing that they're selling some of the future value at a discount, in real terms, the value of that cash to that homeowner is so valuable right now, because it allows them to tap into their home equity when otherwise they simply would not be able to get their hands on that cash.
But it sounds like just to repeat what you just said, it prices similar to a HELOC. It's just the mechanism of repayment is a deferred repayment that is a lump sum payment in 10 years that I presume can be paid either as cash or via the sale of the house.
That's absolutely right.
Do you have the ability to force a sale of the house after 10 years in the event the cash is not provided?
We do, because the investment, or rather the agreement, the home equity agreement, sits on title as a lien. So it's represented by a deed of trust. So the investor has all the same protections and rights that a typical lender would have when they record a lien on title. Another important point, though, is the homeowner can pay this off. They can settle it at any point during that 10-year process. And we have an incentive almost to the homeowner to enable them to pay less if they were to settle this in the early years. So we have a maximum return that our investors can make in any 1 year. We call that our annual return cap. So that means if the homeowner pays it off early, they don't pay the full 20%. They can get a discount on that. The investor still makes a very good return. And the most important point for the investor is the value of the property can fall significantly, but because of the discount that's built into the contract, the investor will still make a positive return. So in other words, there's no other real estate investment that we know of where the value of the property can fall 10, 20, 30%, but still the investor can make a return. And that's really important for investors that are looking to get exposure to residential real estate, but are a little bit worried about where the market's going to go.
All right, let's get into the nitty gritty. How many of these transactions have you done? How many different houses have you sold parts of, and how many different investors have participated?
Well, we've got so our team, we've got experience in across a number of different products, either acting as a direct funder or as an intermediary. We funded, I'd say, between over $75 million worth of agreements as a team. As a company, we have originated, again, either directly or indirectly as intermediaries, around 80 plus transactions. We've been around for 5 years, so this is not a new type of financial product. And the good thing is, the industry as a whole is really beginning to warm up to this because of the returns. And we've seen in the industry over $1 billion worth of these home equity investments have been securitized by other players in the space. So institutional players are coming in. We're seeing the emergence of a secondary market. And that's really what I would love to sort of talk about very briefly.
Before you go to the secondary market, though, I'm interested, of the 80 million you've originated, how many of them have had successful completions, closings on the back end?
None of those have. They're all less than 4 years old. We're beginning to see some of those.
This is the secondary market you're talking about, which is the opportunity to.
No, what I'm talking about now really is how many of those homeowners have actually sold their properties. So the average expected duration of these agreements is around 3 to 4 years. Even though they run for 10 years, what we're seeing as a pattern is people tend to pay them off sooner than that. Now, from a secondary market perspective, there's an institutional secondary market, which is only available to large hedge funds, endowment funds, and institutions. And we've seen 4 securitizations over the last 2 years, totaling just under $1 billion. Now, what our business model is to bring the home equity investment.
Well, hang on. How do you get 4 securitizations of $1 billion with $80 million in originated loans?
That's because that's the industry. That's not us. Those are other players in the marketplace.
Oh, you're saying that in general securitization of secondary.
Exactly. That's right. So it's not, we didn't participate in those. Those are larger institutions.
That's the market size. Got it.
That's right. So banks are very active, structured finance companies are very active in this space. And what we're seeing is a secondary market at the institutional level. But the problem is, as a smaller investor, in other words, as a smaller family office or even as an individual, you simply cannot get access to home equity investments. Now, remember, I said earlier that the reason they're so attractive is because they provide that downside protection. They enable you to get accelerated returns that are greater than the house price index because of the way that these agreements are structured. On the one hand, they're only available to institutions. So our marketplace, which we will be launching to non-accredited accredited investors later this year, enables smaller investors to buy fractions and trade fractions. And that's where the blockchain part of the business comes in.
But before we get to that, I'm still just want to understand the broader. How many different markets are you in? Is it only in one real estate? But you say you had 80 trans. Are you in Chicago? Are you in London? Are you in LA?
Well, we work in
Miami.
Just in the US. So we originate transactions with our own capital, with our investors' capital in California. We work as channel partners with other companies, and that enables us to give access to our customers to their products where we get paid. Going forward,
if I'm an investor and I'm like, I have an opinion on real estate and it's a bullish opinion and I would like to buy some real estate, how many different markets can you show me?
At the moment, California, but our plan going forward is to open up and to invest in new states. So we've got half a dozen states lined up. These are real estate transactions, so we have to go through the licensing process, but we are actively originating and investing in California right now.
And Absolutely. Then the investing itself, or the investor profile, is someone who has a point of view on the value of real estate, or just simply someone who has a point of view, has some liquid cash and has a point of view on the value of this particular contract because it's been so well de-risked.
Well, and again, it's a very good question because the two are actually closely linked. It is a real estate investment. So what we're looking at really, people who are going to be investors in our marketplace are going to be people that want to get exposure to residential owner-occupied real estate. And okay, so they don't want the cost and exposure of owning real estate, but they want exposure to residential real estate. And the reason that our contracts are so attractive and such a clever way of doing it, as if I may say so, is because it gives you access to the equity in homes that are not for sale. Mm-hmm. So you're actually tapping into an asset class that's not really available. And that represents almost $30 trillion worth of equity. So to answer your question, we know that the investors that will be coming into our marketplace are looking for real estate exposure in residential real estate where they can handpick the investments that they go in, where there is downside protection, and when they get exposure to that real estate through this very cleverly structured agreement.
Do you feel that the terms of your investment are so onerous, though, that the nature of the real estate that would be made available would only be that which is that has a relatively distressed homeowner?
No, and we know that empirically is actually the opposite. And I can quote you a deal that we did a couple of weeks ago, which was a large property in Orange County, California, where the homeowner had an 800 plus credit score. The home was paid for. It was the home was worth over $1.5 million. The homeowner just needed liquidity. They needed liquidity without debt. They didn't want to change their mortgage because they'd locked in at a low rate. This was an ideal solution. It's nothing like the distressed mortgages that we saw, a decade plus ago. Mm-hmm. This is a really attractive option to people that are very capable of borrowing money, but simply don't want to.
Mm-hmm. And then again, I know you were heading there, so let's go there. You were saying that because everything you described so far ultimately is contract law for you don't need the blockchain to do anything you just described to me.
That's correct.
You were about to end to the cherry on top, which is it's the blockchain that allows a secondary market.
Well, that's right, because what we want to do, as I said before, is this is a very attractive asset class that is only available to institutions. You cannot buy this as an individual investor. So to enable smaller investors to get access, what we want to do is fractionalize or effectively slice and dice each one of these deals so that smaller investors can buy a piece of that overall contract. So in other words, with a very small investment, like $100 or a couple of $100, you can buy a piece of that contract. You don't get diluted. You don't buy a second rate agreement. You're not diluted through costs or layers of rent that you would normally
Does
get.
it have a multiple, or is it a linear pricing to how do you price that secondary market? Are you going back and revaluing the house and then or is there like?
Absolutely, you can really see how this is going, because the value of the contract is directly proportionate to the value of the property, with that built-in discount that gives that downside buffer. Mm-hmm. So we revalue the property values every month. We use that same independent automated valuation model. And we then say the value of this property today, according to this value, or the value of the contract would be X. So that allows, and the blockchain component, really, we use it. I mean, blockchain really is a very powerful digital or distributed ledger technology in its purest form. So we use that as part of our technology stack to enable us to keep track of where these small pieces of each contract are, where they've been bought from and sold to, because we have a marketplace element that allows investors, once they've purchased this, they will be able to offer their shares, effectively their fractions, up for sale. And blockchain, in fact, is an incredibly efficient, low-cost way of keeping track of where that ownership moves. So we're using it in its purest form as a technology. We don't use any cryptocurrency. Everything is done in US dollars. So it's very predictable. There's no risk of exchange risk, but it's just we're using blockchain in its purest form.
And there's no inflation the price is basically a price that is set once a month based on the robots valuing the house. In other words, excess supply or demand is not an issue in terms of inflating or creating a multiple. All of a sudden, I'm like, oh, Laguna Beach is going to be hot because whatever I might like.
The funny thing is, it's
bid,
entirely possible that will happen because
can I bid my question is, can I bid the crypto? Let's say it's $100 worth. Can I bid it higher than the value of the valuation for that month? I can.
You can, and it's all based in dollars. So if we were to say, for example, that the posted value per share, let's say there's 1,000 shares and they're $100 per share. If you own some of that and you think that you can get more than that, you will be able to put your offer up at a higher price than the current market is showing.
There's a speculative component. It's not just an asset-derived price.
I think it's the speculation really comes from that supply-demand interface. So when we originate these and bring them to the marketplace, they're entirely based on the value of the property and the value of the contract, where one is a relation of the other. Now, what happens when it goes into the marketplace is going to be very interesting to see. I think like most marketplaces, you get supply and demand, you get buyers and sellers. So it'll be very interesting to see what the dynamics are as we bring more and more properties on and you get more and more investors. Then, that's that's going to be a very exciting, sort of interface to be able to watch.
And so what is the use of funds for the money that you're raising on Republic right now? And what is the total amount of money you're raising?
We're raising up to 618,000, which is the maximum we can raise in this particular round. It's the money's there to build marketing. So we want to talk to more homeowners, bring on more investors. We've got to continue to build the legal and compliance structure of our marketplace because we're operating in a tightly regulated securities environment. There's some technology spend. So it's all really about building on the foundation that we already have, bringing it to market, and really just enhancing and growing the number of people that use the platform. Now, we've already been in business for a number of years. We're already generating we're already originating deals. So this is not a sort of startup position. It's really about the growth. This is a precursor to our next round, which will be, we very much are aiming for a priced Series A round. So I think this is going to be very much the last crowdfunding round we'll do later this year or early next year. Markets willing, we will be out there with a price Series A round, which we expect will be at a significant premium to the current value.
And does the secondary market that you're talking about in terms of the ability to buy and sell $100 worth or whatever of a given house, or does that exist right now, or is that?
Yes, it does. No, it's all built. It's not available to non-accredited investors. There's $1 million worth of deals up on the platform right now. You have to be accredited to be able to buy those. You can't trade them yet, but we're going through the process of a regulation A+ qualification with the SEC. And what that means is when it pops out the other side and it's qualified, which will be in about 3 months or so, we expect, that means that the offers on our platform will be available to non-accredited investors, and they will be immediately tradable. And so that will really accelerate the ability for smaller investors to get involved.
And when does that happen?
It's subject to an application, or it's an offering that's going through the process with the SEC. We expect that to be finalized within 3 months. But the marketplace is open today. You can go and have a look. You can pre-register an account. And obviously, most importantly, there is about a month or so left on our Republic campaign if you want to be a stakeholder in Quantum RE as a company.
Quantum RE is the company. Matt Sullivan is the man. I'm Dylan Ratigan. You're watching Tasty Live. This is Bootstrapping, and we're back after this.